All right, so because I'm a big dummy, I forgot to press the record button, or if I did, I didn't press it and then click accept or something. But I for the webinar on music managing business finances did not get recorded. So I apologize for that. So I'm going to go ahead and redo the entire webinar, just me, no participants, and address some of the questions that were asked the first time around. This way that you have all the information that you need to manage business finances using the Profit First system correctly. So I'm going to go here and then share my screen real quick. So here we go. We'll come up to the top. Managing business finances using the Profit First systems. So a couple of things real quick right off the bat that I wanted to discuss. So managing business finance is one of the places that most business owners and entrepreneurs get stuck in because they don't have the experience managing a separate set of finances on top of their own personal finances. And pretty much anything that, as a small business owner, you have to regulate the cash flow that's coming in and out of your business in order to take some home at the end in terms of profits or the rewards and financial compensations that you put in all this time, effort. So you need to get paid for your time and effort. Most financial systems and financial teachings, they make the business finance side of things so convoluted and so confusing with their projections and budgets and spreadsheets and charts that the average small business owner like us don't have time to really get into the minutia of things. So this system works really, really well. I've implemented it since almost day one in my business, and it's grown with me as my studio has grown to the point where it provides me the financial flexibility that I have to run my business full time and get paid enough for it to live my life comfortably. It's awesome. This whole thing is great, and I wanted to share this with you so that way you don't waste your time, energy, and money managing your finances in a way that doesn't work. So let's get into this real quick. The system that we're using is the Profit First system, and it's based on a book by Mike Michalowicz. He is an entrepreneurial guru or author. He writes a lot of business books. Books like The Pumpkin Plan, The Toilet Paper Entrepreneur, Surge, Clockwork, and Fix This Next, along with Profit First. His entire mission is to eradicate entrepreneurial poverty, and he tells the story in Profit First of how he lost it all in business because he was reckless with his finances. He didn't have a good system in place, and he built up multi-million-dollar companies and then just wasted all the money and had to start up from the ground up again. If you are a avid book reader, I highly suggest you read this book. It's very insightful, and we'll get into the details a little bit more than I can in this video series because like I'm limited for time. The audio book, I think is like 6 to 8 hours long. It definitely gets into more of the complexities behind it and the reasoning and the philosophies. I'm just here to teach you the systems that I use, how to implement it into your business, and why you should. Go check out this book, listen to his podcast, Entrepreneurship Elevated. He's fantastic. Definitely a huge resource if you want to maximize, grow, and build your business. So let's get into this a little bit. So the traditional formula that most businesses use to operate, to calculate profit, it goes as forth: sales minus expenses equals the profit. So profit, therefore, is what is left over. It's the final consideration. Come tax time, it's the expense revenue, it's your profit and loss statement. Pretty much whatever you made, whatever you paid out, whatever's left is your profit. That includes what you take home, any extra revenue that the business created that wasn't spent. So what happens is that come tax time, the profit's rarely there, or it's already been spent and you didn't even know it. Your tax statements could be like, oh, your business has made a profit of $15,000, and you turn around to look at your bank account expecting $15,000 to be there, and it's not, because you didn't take care of the profit first. It was the afterthought. It was, if there's some left at the end of the year, great. If not, great. I was able to live my life. And that's based on what Mike calls Parkinson's law, which was theorized by C. Northcote Parkinson, and states that the demand for a resource increases to meet its supply. Some examples of this are in the workspace. So if you're given 2 weeks to complete a project, it will get done in 2 weeks. And if you're given 8 weeks to do the same project, it will take 8 weeks to complete. You find this in finance. If you give $1,000 to complete a project, it'll take $1,000. Given $8,000 to complete the same project, and it'll also take $8,000. And in food, if we fill up smaller plates with food, we'll consume the entire plate. However, if we fill up a larger plate with food, we'll also consume the entire plate. This is why at buffets, they leverage mostly sometimes little or smaller plates. So to force you to eat, it's a psychological thing where the buffets then save money because you ate less. You don't want to make multiple trips. And when you're trying to lose weight, most dietitians suggest that you shrink your plate size so that way you still get the same psychological benefit of completing your meal, finishing your plate, but you're not consuming all the unnecessary calories that you would if you would have filled up the plate, a much larger plate. So in finance, we need to shrink our plates, our financial plates. Using Parkinson's law as an asset for your business to work for you and not against you. What we need to do is we need to divvy up our money into smaller plate sizes. So instead of it all being in one account that we see, and then have the tendency to spend it all, as Parkinson's law dictates. If you see all the money in one account, you have the tendency to spend it all. We're going to divide our money into smaller plates for specific purposes in your business so that you do not have that overwhelm of seeing so much. We call this, I'm not sure if Mike refers it to this in his book, but I refer to it as your financial diet, restricting what you're consuming to make your business optimal and healthier. Much like your body, when you shrink what you consume and only consume what you need, you're in a much better healthy state. Same thing with your business. And by shrinking your plate sizes, it forces you to do more with less. That $1,000 for a project versus $8,000 for the same project, you can accomplish, it forces you to accomplish or to think outside the box in order to achieve your goals using the same amount of resources that you have available or less resources that you have available instead of the overwhelming number. We'll get into that a little bit more here soon as well. And I'm talking a little fast just because I did this once and now doing it again. I'm trying to go through it quick, but I should probably slow down my speed of teaching so that way you understand the concepts a little bit more. So from here on out, I will be toning it down just a little bit. So the profit first formula, the traditional formula as a recap was sales minus expenses equals profit. The profit first formula flips it on its head. So if you remember the, I don't remember now if it's the associative or the distributive or the communicative property, I believe it's the communicative property, where you can interchange integers so that the logic, the mathematical formula stays the same. We're going to flip the expenses and profits. So the formula will now read sales minus profit equals expenses. Not sure why, oops, I hit the wrong button, so this is coming again. We're going to remove a predetermined percentage out of every sale to be reserved in a profit, for profit, tax and other things as well, which then lessens the amount available for expenses. forcing you to think outside the box more creatively on what you are spending your money on. Otherwise, we'll spend frivolously because we know, hey, yeah, we have enough money to cover it. But do you really? Find creative ways to get the same done with less. And you don't want to stress in tax season. So we'll be removing not only profits, but also your tax liabilities as well. So that come tax season or come your quarterly estimates being due, you're not stressing over looking for the money to pay your tax bill. And it removes the temptation of unnecessary spending. That big purchase that you want to do, it's a lot easier to do when you have a big account full of tons of money and not think about your tax liabilities or tax burdens and employee payroll, what you're taking home, because you see that new shiny object that you want, that brand new piano that will look great in your lobby or that teaching room, or you want bigger screens for teaching online lessons, you want the new cameras, you want the new music materials, whatever it is. This removes the temptation of spending unnecessarily on things that aren't essential in your business. So we'll utilize bank balance accounting. Human nature and human tendency is tough to beat. As entrepreneurs or small business owners, we look at these financial projections and spreadsheets and numbers and charts and graphs, and a lot of it just goes over our head. When we go out into the world as consumers, a lot of us just check your bank account on your phone, see that you have the money there, and then proceed to make purchases based on what your bank balance tells you have. So bank balance accounting in your business will simplify how you look at your business finances. You could skip the spreadsheets and the charts. You leverage Parkinson's law, and it gives you a quick snapshot of your financial health in a few seconds. You can then make financial decisions based on the availability that you have in your accounts, which is Parkinson's law. If you have the resources available, then you can use them and leverage it to the needs that you want. If you don't have the resources available, you'll be forced into creative thinking to make those projects or purchases a little like stretch. You're going to stretch your budget out, your balance, your money a little bit further by looking at bank balance accounting. Instead of spending $300 to run a Facebook ad, what can you do if you tweak some stuff, or if you tried a different form of advertising? Maybe you could save $100, $200 and still get the same results. This forces you to think creatively and outside the box. You're going to set up different accounts for different purposes. That way, when you take a look, you can quickly assess the financial health in the 6 different areas of your business. You're going to allocate your finances onto smaller plates for specific purposes as well. So that way you're not looking at the entire pie or the entire your entire financial situation in one bowl, trying to do mental math and be like, okay, well, I have to pay so-and-so $600 and my rent bill's coming up and I still got to take some money home, and all that mental energy that takes. You don't have to worry about that. You'll see where your money is going, which makes it easier to view, track, and measure. So seeing where the money is going and how much you have and where it's going, you can then simplify that out into a simple profit and loss statement, see how much you're spending on specific items, and then make decisions on how to cut costs or increase revenue. Just by looking at your bank account, you can do all this. No need for all those fancy graphs, projections, and charts, which gets really confusing and overbearing. So I'll teach you how to do this in a bit, but first I want to talk about the habits that we employ as consumers and how that can translate into how we manage our business finances as well. You're going to want to use habits to your advantage. So don't try to be better at finance if you're not good at finance already. Don't try to implement all these tips and strategies and tools to try to force your way into becoming better at something that you're not. Improving this aspect of business and business in general is a skill. and it's a muscle. And the more you stress and pull and use that muscle, you're more prone to fatigue and stress. Fatigue and stress then cause you to break the rules and pull money or spend frivolously just because you want it. Let me see how Mike relays it. See, he mentions this beautifully. Let me see here. But just like a muscle, willpower can be drained. And in the moment of financial stress or bigger than expected expenses, the entrepreneur will break their own fiscal rules and spend the money they have, even if they know they shouldn't. So the profit first system doesn't change your natural human habits and human tendencies. Instead, it complements them. It causes you to remove the temptation to borrow from yourself, or even worse, borrowing from the government, which is what you do when you dip into your tax fund and spend your tax burden on frivolous things in your studio or to cover expenses and costs. And it causes you to be fiscally strong and benefit from profit distributions. The profit distributions are the magic behind this entire system, and we'll get into that a little bit more detail later on. But this whole thing is geared to having you leverage your current habits to your advantage instead of trying to create new habits that don't feel natural to you and trying to implement things that you know don't work for you. So the process. This is how Profit First works. So Profit First requires that you have multiple accounts designated for multiple purposes. And to make this really something that will force you to stick to it, Profit First, and Mike tells you in the book that you're going to want to have two different banks set up. So Bank A and Bank B that are difficult to interlink because you don't want to pull money from a specific bank to cause your, for expense purposes, whether you're taking it home or you're spending it in your business. So the first account in Bank A that you need to have is your income account. That is where all the money in your business is going to go. Any revenue that you come in, whether it be from tuition, whether it be from merchandise sales, whether it be from performances, whether it be from recurring revenues that you have through courses that you create, whether it is you're selling books and merchandise, it all goes into your income. If your income is scattered throughout different methods, so like some people are paying cash and check, some people are on auto pay, some people are Venmoing it to you, some people are sending it through PayPal, Zelle, whatever it is, make sure it all gets conjoined together in the income account in your primary A bank. Oops. So from there, you're going to have two more accounts in your A bank, and you're going to open up 3 accounts in your B bank. The accounts in your B bank are going to be, your B bank is essentially your no-touch bank. Is your profits, your taxes, and your vault, which is your emergency fund account. In your Bank A, you're going to have your owner's compensation. This is where you will pay out your own monthly salary. It's not your take home. This is not your personal checking account. It is a separate account from which you pay your own salary. And then your operation expenses account, which is where you pay all business operating expenses, from payroll to rent to utilities to merchandise to books to insurance, new gear, new computers, new instruments, everything that you will pay from, will be coming out of your operation expenses account. So you're going to divvy up your income account, which is in Bank A, into these other accounts by predetermined percentages. So for example, 10% into profits, 15% into taxes, 5% to your vault, 40% to owner's compensation, and 30% into operation expenses. So step number 1, you're going to want to create your accounts. You'll need a total of 6 accounts between 2 banks. Income, owner's comp, operation expenses in Bank A, which is your primary bank. and your profit, tax, and vault accounts in Bank B, which is your no-touch bank. Out of these accounts, only one of them needs to be a checking account, and that is your operation expenses account, because that is the account that you're going to be paying your bills through. So you want to make sure that you have checking capabilities and link it to a debit card, so that way you can do online payments and all this other stuff. The other 5 banks can be savings accounts because you're not going to be paying anything directly out of those accounts. By doing so, you remove the temptation of access. You want to make Bank B a different bank because you do not want to make it easy to transfer money from your tax, profit, or vault into owner's comp or operating expenses accounts. You want to force yourself to work with less. Also, you kind of let the money sit and grow in those accounts if you can find a bank that has a good enough interest rate. I'm with Capital One on my no-touch accounts. Their savings options provide, I think it's 1% annual yields. So the money sits there and grows interest over time. It's not large in the grand scheme of things, but they will sit and grow and develop some interest. And you want to make it difficult to access. So make it to where you don't have any instant transfers. It takes 2 to 3, 4 business days to transfer money in and out. You want to make it as difficult to access as possible because, like I said, you don't want to fall into those temptations of making short-term decisions based because you have the money sitting there in your tax. It's not your money anyways, it's your government's money. Don't use the government's money to pay for a shiny new piano. Number 2, you want to determine your TAPs. So the TAPs are your target allocation percentages. That's what you want to strive to hit on your percentages. So how much you want to be putting into profit, tax in your vault, how much you want to get paid, and how much you want to spend on business expenses. And to do so, we need to start out with where you are and where you want to go. So what's your gross income per month? If it's $8,000 a month, if it's $10,000 a month, if it's $5,000 a month, how much are you bringing in per month for your services? Then we want to deduct our expenses. So say we're bringing in $10,000 a month and you're spending about $3,000 every month on your expenses. It fluctuates, but you want to get an average. So 3,000 would be 30% of all income needs to go towards expenses. Then how much do you need to bring home every single month? Do you need to bring home $3,000? Do you need to bring home $4,000 every month to live comfortably? We're not living lavishly right now. We are living comfortably. How much do you need to bring home every month just to live? If it's $4,000, then you need to set your allocation percentage to 40%. How much profit do you want to take? So Profit First recommends that you take 1% in profits starting today for the duration of the quarter. So out of all the income, you're going to take 1% out. Every time you get paid, 1% of that money goes out and is stored into your profits account. For taxes, rule of thumb is you want to reserve 15 to 20% into the tax account, and you want to keep it steady there unless you're forced to increase it because your tax burden becomes too high. The rest is up to you. So if you want to put money away for long-term savings, if you want to put money away into your retirement account, your expenses and your take-home pay, that's fungible depending on your specific situation and what your needs as a business owner and as a human being are. So that's pretty much how you come up to that. And just as a footnote, the TAPs are your target, not your starting point. So we'll refer to the starting point as CAPs, or current allocation percentages. So after you determine where you want to go, figure out where you are now. How much can you divvy up? So say you're not making $10,000 and you're making $8,000, but it still costs you $3,000 to get everything paid. So your expense percentages are going to be a little bit higher than the other ones but you are striving for a 30% being $10,000, $3,000 of your TAPs. And that will come every quarter. We'll do evaluations and adjust the allocations accordingly. You want to keep your caps stagnant and the same throughout the entire quarter. So step 3, all the money goes into your income account. Send all sales receipts to your income account. Regardless of where they're coming from, they need to all be consolidated into one account first and then distributed among the other accounts. It just makes for easy accounting. You don't want to be pulling percentages from different things. That makes it way too complicated. So put all the money first into the income account and then distribute it out. Let the money sit there until we allocate it into the other accounts. The allocations are going to be done twice a month on the 10th and the 25th. If you get paid throughout the entire month, this works great because you're getting revenue recurrent. If you charge at the beginning of the month for the entire month and everyone pays you, say, on the 1st, you're going to take half of the amount that's in your income account and then do 2 allocations on the 10th and the 25th, 2 even allocations with that. As a bonus, if you want to make bill paying a little bit easier and coincide with your allocations, call your service providers and utilities and your bills collectors to change your billing dates to the 11th and 26th. So that way, after you've moved your money around, you have the financial ability to then pay your bills. And you kind of want to try to split them up as evenly as possible. And if not, then just try to figure out, like, if yours are due, you'd pay the 25th, the 25th allocations would go to any bills going from there until the 10th. And then from the 10th, it'd be from the 11th until the 24th, stuff like that, if you can't consolidate your bills. Number 4, the allocations. I'm going to take a quick pause here to use the bathroom. All right, we're back. Okay, step 4, the allocations. So this is how we're going to allocate our money. So again, it's done every 10th and 25th. You want to make this a ritual. You want to make this a habit. After you get into the swing of things, you'll look forward to the 10th and 25th every single month, because that's essentially payday. That's when your business gets paid. That's when you get paid. And after doing this a couple times, maybe the first quarter or so, you'll find that it's super easy to do. Maybe you'll spend 10 to 15 minutes doing this instead of worrying about projections and stuff, which you could slave away for hours doing. It becomes seamless, simple, and actionable and repeatable. So the more you make this a ritual, the better success you'll have. It takes me about 5 to 10 minutes to run allocations, and a little bit more because I'm a nerd and I like to track things on a spreadsheet and stuff. I go a little bit above and beyond. But at first, it took me 30, 40, 50, 60 minutes to get this done because I wanted to make sure that I was doing it right. So it might take you a little while at the beginning, but the more you ritualize and the more you can be consistent with this, the easier it'll become over time. So you're going to transfer the funds from your income account to the respective accounts using your caps, which are your current percentages. And then you're going to do it in this order: profit, then tax, then owner's comp, and then operating expenses. And after that, the vault, whatever you want to put aside for emergencies. The reason being is that you want to prioritize those things in that order. You want to prioritize profits because your business exists to produce profits for you. First and foremost, you always want to take out your profits. If you don't take out your profits and you're sacrificing your profits to owner's compensation or operating expenses, you're not doing it right. The second thing you want to value is the tax burden, because the government is very finicky and picky about making sure that they get paid for what you do. They want to take their percentage of your pie. So you don't want to mess around, don't want to play games with the government. The next is the owner's comp, because that's the next value of importance. Profits do result in you getting paid. Owner's compensation is your monthly take-home salary. You need to get paid. And then operating expenses is next. You want to make sure that you have enough to keep your business running. But at the sacrifice of owner's comp, it's not worth it. Make sure that you're taking home something before you have your business pay out its debts. If you can't afford to take home a salary, your business is spending way too much money and you need to cut down on your expenses. So this will force you to really look at your expenses and see what you can cut. A lot of things that you have in your business might be frivolous and might be unnecessary. So this hierarchy provides you with that picture to really see what is important. And then last is your vault, your emergency fund. If you have excess money left over and you can pay your expenses, then set aside a portion of that money into a vault account, which would be your business emergency fund for when things hit the fan. After you've done your allocations, you are to pay your bills and expenses only from your operating expenses account. No other account. Don't go and put money from your own pocket back into your business. Whatever you have to operate your business from your expense account, that's all you have for the month or for that half month to pay your expenses. If you cannot pay your expenses, cut things first. Don't go into your pocket and pay for the extra stuff that you don't need. Shrink your expense liabilities down as much as possible so that way you can provide for all the other aspects in your business. You're going to pay your salary from your owner's comp account. So your owner's comp account is not your personal checking account. It is a reserve account for your salary. Do not drain this account every single pay period. What you want to do is leave extra funds in there in case you see a drop in students' income or were hit by a pandemic. So this system caused me to not go under from the pandemic and not lose my own personal salary because I had enough reserved in the owner's account to keep a consistent paycheck. So for example, say we need $4,000 to live on. That means every allocation, we're allocating $2,000 into the owner's comp account. But to create a little bit of a slush fund there to keep your payments, your self-pay consistent all the way throughout in terms of bumps and raises and drops in revenue just by cost of doing business or catastrophic emergencies, whatever that may be. Maybe allocate $2,200 or $2,250 per allocation and leave that extra money in there so that it builds, so that 1 month that you lose an exorbitant amount of students and can only put in $1,800 into the owner's comp account, you can still take home the $2,000 needed to live your life comfortably. Don't fall into the trap of making your income reliant on how much business you are how much business revenue you are generating at a specific month. You want that to stay as consistent as possible because If you're struggling financially, the stress and overburden is going to seep into your business, and you don't want to do that. So always take a little bit more than you need and leave it in the owner's comp account so that later on when you need it, it's there so that you don't have to cut your way of life. So this is going to create a reserve so that way you have consistency in your take-home pay. Easy, simple, actionable. Leave your profit account alone. So your profit account is the reward that you take for being a business owner. And I'm going to explain the magic of this account in a little bit. It truly is magical the way the profit account works and how it builds over time and how much you'll look forward to every single new quarter once you start implementing the system. Leave the tax account alone. It's not your money anymore. Once you've put it into the tax account, it's there to pay your quarterly taxes and your business and personal taxes come tax season. So your business was created to serve you. First and foremost, obviously it's there to serve your customers and your clients, but we don't go into business to create no revenue and to have no benefits from it. Otherwise, we create nonprofit organizations or do more charitable work or stuff like that. The reason we're a business is to live a life that is taken care of by the business. You want the business to take care of you personally. That's why your business tax account will pay your tax liability for the business and all your personal taxes come the end of tax season. You have it there in reserve. And you want to aim to have about 6 months of revenue in your vault account. Going back to taxes real quick, whatever money you don't use in taxes at the end of the tax season, you could take that home as profit as well. That is your refund from the government, even though it's your self-refund. That either goes into the profit account or you get to take it home as a bonus, as a refund. Have about 6 months of revenue in the vault account. That's a long-term goal. It's not going to happen overnight. The key there is you want to take percentages, recurring as much as possible, and put them into the vault account for emergency purposes for about 6 months. Say the government shuts everything down again for 3 months. Well, you don't have to worry about trying to rush and create new services and make crazy transitions that you're not comfortable with, because now you have 6 months of revenue in your vault account to cover business expenses and your own personal expenses for the next 6 months. You don't have to worry about the government sending out stimulus or well, I don't even want to call them stimulus checks, because that's not what it is. It's kind of like a disruption check. You don't have to worry about the government passing bills to send you money, because you have that money in reserve. Your business has in the reserve. Your business is there to take care of you. Accumulate this over time. It is your emergency fund. So over time, don't touch your business account, your vault account, your emergency fund. These 3 accounts, do not touch them. Once you allocate money away from that primary bank, leave it alone, with the exception of the profit account, which I will get to in a little bit. Do not touch ever. If I haven't made that clear, do not touch these accounts ever, except for the profit. Profit distributions and the magic of this system. So, profits are your reward for the risk you take as a business owner. So, for example, let's say you are a publicly traded company. You own 100% of the stock in your studio, in your business. As an owner of your business, you own 100% of the shares of that business. Much like Ford, which is the example that Mike uses in his book that I like to use because I am an investor in Ford, is an operating publicly traded company. Since I own shares in Ford, I am a percentage business owner of Ford. When Ford has a great quarter, they reward their shareholders with percentage of profits. Since I own a very microscopic percentage of Ford as a business as a whole, I get microscopic profits. As a 100% stakeholder in your business, you get 100% of the profit shares. So profit distributions are done on a quarterly basis based on how much money you've put in over the last quarter. So those quarters, those fiscal quarters are January, April, July, and October. Every quarter, you'll take 50% of the amount accumulated in the profit account as a distribution of income. So you just take that home. No need to put it into your owner's comp account and then home. You just transfer it straight home into your pocket. It's your bonus for running a business. It's your reward for taking the risk. It's your distribution. It's your investments working for you. Congratulations, business owner, you've earned it. Every dime of your profit distribution has been hard worked and earned. The remaining 50% will then stay in the account, and then you keep adding to it, which stacks on top of each other, helping it grow exponentially. So an example of what that looks like, we've got 4 quarters here. So quarter 1, we're starting our profit first journey with $0. And for this example, just to make the numbers and the math easy, I'm assuming you have a $10,000 per month business, and you set your caps, your current allocation percentage for profit at 10%. So we're going to add January's profit distributions, which it will be $1,000, February and March, giving us a total of $3,000 in the account. And then come April, you'll give yourself a distribution of half of that, which is $1,500. Congratulations. So now your account in quarter 2 starts off at $1,500. And assuming that this cap is now actually your tap, and you don't want to change anything, you feel good, you're making enough money, you're not trying to focus on growth, your business actually does not grow, which is unlikely. Your business will grow over time. For the sake of simple math, let's say your business doesn't grow, you don't change your allocation percentage from 10%, and we add another $3,000 over the course of quarter 2. Now that account has $4,500 in, and your distribution is $2,250. Wow, you're making more money. By doing the same amount of work, now you're getting distributed more money. Quarter 3 starts off with the account at $2,250, and we still don't change anything. We're gonna keep everything the same. $5,550 in the account at the end of quarter 3, and your take-home distribution is $2,775. Quarter 4 follows suit, and you take home a distribution of $2,887.50. Now, the cool thing about this is that we haven't changed anything in the business. The business kept the same all the way through, $10,000 revenue month to month to month. You kept putting in a consistent amount of 10% into your profit account. The cool thing is that you're going to be reevaluating your business every quarter, determining its growth. So if you grow from $10,000 per month in the first quarter, now you're doing $12,000 in the second quarter, instead of distributing or instead of allocating $1,000 per month, it'd be $1,200 per month. And let's say this, say you now, since you're making more money, you want to increase your distributions to 15%. Well, now it's even more than $1,200 per month, which stacks on what was left over, giving you even more profit at the end of every quarter. Using this example here, we've made almost $10,000 in distributions over the course of the year. This is bonus on top of your owner's compensation. So your owner's compensation, the way we structured it, will have you making the same amount of money to live comfortably, to pay your mortgage and rent, to pay your utilities, to pay leisurely activities, and all the lifestyle things that you want to have. That comes from your owner's compensation. The profit is bonus. It's the cherry on top. It can be used for anything. Are you looking to save up to get rid of debt? Use your profit account for it. Use your profit distributions for it, I should say. Sorry, my computer got all funky. So what I was saying is your profit account is your bonus. It's your distribution on top of everything else. It's the cherry on top. If you're wanting to pay down more debt, use your profit distributions to do so, to clear out all your debts. If you're looking to buy a new home, use your profit distributions to save up for a down payment. If you're looking to buy a new car, if you're looking to go on a vacation every summer, every quarter, whatever it is that you want to do, trying to get debt free completely, use your profit distributions as leverage for other things that you want to do. If you want to make more investments, if you want to invest into your retirement, if you want to invest in stocks, if you want to invest in real estate, use your profit distributions to do all the extra things and live the life of your dreams that you can do so with all this profit distribution. Instead of allocating this directly as take-home pay from the onset and then spending it frivolously month to month, doing so every quarter, giving you that bonus makes you, one, feel really good. It makes you look forward to every quarter, makes you want to do a better job in business to increase the profit distributions. And it gives you a nice injection of cash that you have at your disposal now to do whatever you feel like. Obviously, yeah, we could take all this money and just give it to us every month, but $1,000 a month versus $3,000 a quarter in one lump sum, it forces you to save and then reap the benefits of that. The math is the same, but the psychological benefits are so much better. So that's why I really like this. This system is magical. When I first started off doing the Profit First system, my first distribution, I believe, was I had $300 in the account, $150 was my first profit distribution. Small potatoes, but I was able to use that money to take my fiance out, then girlfriend, on a date, a nice fancy date night. I think we did movie, dinner, and all that stuff. It was great. We had a great time. And it was just a reward for being a decent business owner. My last profit distribution in Q2 of this year was $1,600. My next profit distribution is going to be $2,000 and some change. And then consistently throughout, by next year, I should be having about a $4,000 profit distribution if projections on my business are accurate. $4,000 injected 4 months, that's an extra $12,000 that I'm bringing home on top of living what I consider to be a decent, comfortable life. And then $12,000 just on top of that, I can leverage that for whatever. Currently, I'm allocating all my money for a wedding. I'm getting married in January, so all of my profit distributions are going to fund my wedding. And it's fantastic because she doesn't have to worry about setting stuff aside. She can save for things like furnishing our home and other things like that. It's great. Once you get a taste of how awesome this feels, you'll never go back to budgets, projections, and blah, 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 this and that. Profits are your rewards. Do not plow it back into your business. When Ford sends me dividends every quarter, I don't go turn around and call up the CEO of Ford and say, hey, Mr. Ford owner CEO guy, you gave me $10 in profit distributions for being a part owner in the business. I feel like you need this $10 more than I do, and give the money right back. Don't do it. You grow your business through your operating expenses account. If you don't have enough money in operating expenses to set aside for reinvestment in your business, you're doing it wrong. You don't have enough revenue coming in. Profits are your rewards. Don't put that back into your business. That defeats the purpose of the profit system. This is to reward you for being a business owner. You cannot serve your clients if you're not taking care of yourself first. Take care of yourself first. After, so that's done every quarter. Another things you want to do every quarter is to make sure you take your profit distribution. Make sure you pay your quarterly tax estimates from your tax withholdings account. Reevaluate your caps and get them closer to your taps. Remember, your caps are where you are currently. Your taps are where you want to go. Try every quarter to inch your way up to hit those target allocation percentages. And these are fungible as well. These can change depending on your needs. So the quarter is a perfect time to reevaluate your caps. If you're saying, say you had 50% in operating expenses and 5% into profits, change profits to 6% and your operating expenses to 49%. If you can run a business on 50% of total revenue, you can run your business on 49% of total revenue. The changes are going to be minuscule, over a certain point of time, which forces you to adapt and change to the current circumstances, the current allocation percentages, and then you can reevaluate every single quarter. If you had 50% in operating expenses, but by tracking, you've always had surplus in that account to the tune of about 5%, then increase your profits by 5%, or give yourself a salary raise per month and split it to 250 and 250. Either way, quarterly times are the best times to do because it gives you 3 months to get used and to adapt to the new systems, to force yourself to think more logistically, and gives you a much broader snapshot of your business. Track and measure your growth quarter to date and year to date to see where you stand financially from where you were. Don't measure yourself against other businesses. Measure yourself against what you were in the past. So you want to see consistent, steady growth. Every now and then you may see a month or two of drops, especially if a pandemic hits and stops business completely. But you want to make sure that you're doing the right things month after month, quarter after quarter, year after year, to see your business continue that ascension to the top. So at the end of the year, you're going to track your financials every quarter, every year using software. I like to use my music staff for my profit and loss. It provides all money coming in, all money going out, and then the total revenue left over was my take-home pay as a sole proprietor. That's the easiest way for me to do it. I don't have to track my own take-home out of it, just what I'm bringing in and what I'm paying out. Whatever's left is what I pay taxes on, which are in the tax account. Evaluate your business's financial health. So check out where you're standing up against last year, how your trends were throughout the year, if you're in an upward trajectory, if you're in a downward trajectory. Track how much you've spent year over year, month over month, your earnings, your profits, your taxes, your assets, liabilities, debts, rates, etc. Yearly evaluations are the best time to do that because you can see, again, a broad picture of what happened, so that way you can project forward. Then you're going to want to create goals and checkpoints for the following year and break down your goals into quarters. So say you made $50,000 in revenue year one using this system, and you want to increase revenues by 20% for the next year, which means you need to make $60,000 in the subsequent year. Break that down by quarter. You need $5,000 biannually, and you need to be up $5,000 where you were the year previous by the halfway point, and that means every quarter you should be making revenues of $2,250 previous from what you were the year before. So create those goals by looking at these financial pictures afterwards. And now, while the 6 accounts are essential to have, it doesn't have to stop there. You can have many other different accounts. This is Profit First Advanced for what Mike calls, but I've simplified it and reconfigured it to adapt to music studios. So retirement, that comes from your owner's expense account. So say you need $4,000 to live on. You're going to be allocating a little bit higher of a percentage, maybe 45%, so $4,500 into your owner's comp. Not owner's expense, let's just say owner's comp. Owner's comp account. And then you're going to take from there a percentage of that money is going to go into your, or a set amount, $200 a month, $500 a month, whatever it is, that will go into a personal retirement account that you have, either an IRA or stock options, or you can't do 401ks unless your business has a 401k, then you can go ahead and do that. Yearly expenses. So an account for yearly expenses like insurance or membership fees that get billed once a year. You create a separate account and withhold money from your OpEx. So say you have an insurance bill due yearly for $600, and you don't want to come to that point, that month in the year, and have to pay $600 out of your OpEx because you've worked out your numbers and you have that consistency. Well, what you want to do is create a separate account specific for those yearly expenses and take and put money there from your OpEx account after it's been allocated to that account. So say $600 insurance bill due once a year. You'd pull $50 a month after you do your allocations from your OpEx into the account. And then come that time that you need to pay the bill, it's there ready for you. You write the check, transfer it over to your OpEx, write the check and pay it out. Long-term savings. So this would be for like a new instrument, studio upgrades, or wanting to move to a bigger location. This also comes from your OpEx. Say you want to buy a $3,000 new piano for your studio because the one you have is kind of falling apart and it's more expensive to fix than to replace. And you have a 6-month time frame to do so. You need to set $500 a month, $250 per allocation into a long-term savings account to save up for that expense. Prepaid tuition. So if you have clients who prepay you for months in advance for like an entire semester for the year, you want to create a drip account to hold funds that drip into your income account monthly. For example, say you have a student that prepays for a 5-month semester. It's $500 for the semester. They prepay. You would drip $100 a month from your drip account to your income account. That way it's a steady increase and you're not just plopping all the money in there at once and then distributing it and then spending it because now it's available in your operation expenses account. And then you can adapt this model to fit your own studio needs. So whatever other accounts you deem necessary, you can do so. If you want to have a slush fund for employee PTO, that's fine. If you need to have a slush fund for advertising or creating different budgets or multiple long-term savings accounts for different projects, go ahead, go for it. And then Q&A was the open question and answer segment that I did in the webinar. But since this is done post, I'll kind of review some of the questions. One of the questions was, and I think the biggest question was, after you distribute your profit accounts to yourself, how does that reflect on your taxes? And like I said, as a sole proprietor, I don't have to claim personal income because my profit and loss statement is whatever the balance is there, that's the income that I took home over the course of a year. And that takes into account the money that was put into tax reserves, profit reserves as a total, and money that I took home in salary. So all I have to do is print that out and give it to them, and then we work out the numbers and whatever's left, that tax burden, it comes out of your tax account. Now for LLCs and corporations, it's a little bit different because you do have to provide yourself a paycheck. So when it comes to that, you have to itemize that as an expense as the business. So you will run 2 separate tax forms. You'll run one for your business, and then you have to run a personal tax. So your business operating and expenses, or your revenue and expense, your profit and loss statement will be solely for your business, and then you itemize your profits distributions in there as well. So your profits, your withholdings of profits as a whole, as the whole group before you distribute it, will show up in your business profit and loss because it was money that wasn't spent. So you'll get an actual picture of your business profits, and then the distributions will have to be claimed personally. So you say that you write yourself a check and you itemize that in the W-2 that you get as a corporation. Okay. Or classified as an owner's draw, I think is LLC. I think that's the term for that. So that was the main question. There wasn't many other questions. If you have questions on this, feel free to join my group, my Facebook group. It's facebook.com/groups/eager entrepreneurs. I'll post the link to that below. If you're already in the group, I may do some profit pods, which is small breakout groups that meet weekly to help you set up your own profit accounts based on your needs and your specific situation. If you would like that, come join the group. I'm going to set those up maybe Fridays in the early afternoons for people who are all over the place, or whatever time works best for you guys. We could do individual basis or group basis. But yeah, I hope this was helpful for you guys. Highly recommend reading the book for yourself. If you're a book reader, and implementing this. It's a super simple system that has worked tremendously for me in the past couple of years. It's what allowed me to survive the pandemic because I had extra revenue just sitting there waiting to be utilized for different purposes. I don't have to stress about money. The money is there. It takes little to no time to do this. It's clean, it's concise, it's simple. And it's something that you can use and grow, that grows with you as your business grows. The principles and the numbers are going to change, but the percentages is what you're working with. As long as those percentages are there, the more revenue you bring in, they just get distributed. And then once you see that there's a skew towards one way or the other, those quarterly evaluations will help you redirect the ship into the direction that you want to go. Highly, highly, highly recommend you start implementing this today. So start opening your accounts, get things set up, and then start taking away your profits now. So that way you can reap the benefits come October 1st. I'm super jazzed about it because it's a $2,000 profit distribution. Like, holy cow, that's insane. That is an insane amount of money as a bonus. I'm super jazzed about it, even though I know it's going to the wedding. But just when I transfer that money over and I see it pop up in my account, it's so cool how like simple and easy to use that is. So if you guys have any questions, feel free to reach out to me personally. You can join the group. I really suggest you joining the group. And if you want more webinars like this, I have what I teach is the 8 pillars of business foundations that apply directly to us as music studio owners that I've been teaching for the past 4 months. And I feel like I've been helping out so many young business owners get started in business financials and understanding business. Let me stop the screen share. But yeah, I feel like I've been helping so many people out, and this is totally free. I'm working on refining my skills and getting the message across in a clear and concise way, and trying to improve this every single time I meet with somebody. But I do one-on-one consultations. If you're interested in something like that or learning more about the 8 pillars, please reach out to me, join the group. We'll set up a consult. It's completely free to use. There's no catch, there's no nothing. There's no course for you to buy. I just really, truly want to help people. My entire mission in starting a studio in the first place was to help give the gift of music to everybody in my community. And then I thought, why stop at people in my community? Why not reach, have a more global or at least countrywide impact? And by helping you guys as studio owners master these business concepts, which will help you reach more kids, more students, learn and love and appreciate music, I fulfill my mission and my objective that I started out with. And I think it goes hand in hand. So honestly, if you guys are struggling with some business stuff, please reach out to me. I'm willing to help. I'm here to help. I want to help. Hope you enjoyed this short webinar. I apologize for not having done it correctly the first time. If there's any questions that you have, anything went over your head, please don't hesitate to reach out to me, and I will get back to you as soon as possible. Thank you very much. Hope you guys have a great rest of your day or whenever it is that you're watching this. And I look forward to meeting and working with you guys soon, one day.